look at the latest market action. I mean, really look at it. Is IREN Limited this, undervalued AI powerhouse that's just waiting to erupt? Or is it a highly volatile value trap, ready to catch all those unsuspecting retail traders holding the bag?
Man, that is the multi-billion-dollar question just hovering over the entire market right now
Oh, yeah.
because the charts are flashing these massively conflicting signals, right? The fundamental business model is shifting radically. And honestly, the stakes for anyone holding this stock, they really could not be higher.
No, absolutely not.
Yeah.
And we're unpacking all of it today in this deep dive.
Yeah.
But real quick, make sure you hit subscribe and like the video because you'll definitely want to follow this storyline closely.
For sure.
And hey, it is compulsory. You have to tell us in the comments right now, before we even start, are you team bull or team bear on IREN? Let us know where you stand as we, go through the numbers.
Get those comments in, yeah. It's always fascinating to see where people are at before we ruin their day with the data.
Right, exactly. Okay, so let's get into the overview. The core mission of our deep dive today is unpacking our stack of sources on IREN Limited. So as of today, April 21st, 2026, the stock is trading at exactly $48.72.
Yeah, 48.72.
And the story here is just fascinating because we are watching a company execute this massive real-time strategic pivot. I mean, they are actively transitioning away from their legacy business of Bitcoin mining.
Which is wild in itself.
Right, to try and become this leading AI cloud infrastructure provider.
Yeah, and it's not just a pivot, it's an incredibly expensive identity crisis.
Wow, an identity crisis. I like that
Well,
one.
it is. I mean, you are taking an organization that was built entirely on the volatile cyclical economics of cryptocurrency extraction, right? And you're trying to rewire its DNA to become the foundational bedrock of artificial intelligence computing.
Two totally different beasts.
Exactly. The operational demands of those two businesses are wildly different.
Yeah, they really are. Now, before we get into the weeds, we have to state very explicitly for everyone listening, while we are bringing natural human debate to these sources and breaking down the numbers, this is purely an analysis of available data.
Strictly not financial advice.
Strictly not financial advice. We are just here to educate and explore. But to wrap my head around this pivot, I keep thinking of it like a gold miner.
Okay, lay it on me.
So imagine a company that has spent years digging for crypto, right? And suddenly, literally overnight, they decide to drop the pickaxes. They aren't digging anymore. Instead, they look around and say, you know what? We are going to build the railroads for the impending AI boom. It's just a massive shift in how they generate value.
I mean, the railroad analogy works, but let's take it a step further to really understand the mechanics here.
Okay.
Building railroads requires an astronomical amount of upfront capital before a single train ever runs on the tracks, right?
Right. You need the land, the steel.
Exactly. You have to buy the land, lay the specialized steel, build the stations. Well, in IREN's case, the land is data center real estate. The specialized steel, that's tens of thousands of high-end graphics processing units, GPUs.
Which are not cheap.
Not even a little, and the stations are these massive electrical substations. So it is a transition defined by just suffocatingly heavy capital expenditure.
Which means we need to look under the hood at the actual money coming in and going out, to see if they can even afford this railroad.
Let's do it.
Let's unpack the income statement. So, for fiscal year 2025, total revenue hit an impressive $501.02 million.
Yeah, $500 million.
Right. And looking at the latest quarterly data, FQ2 of 2026, revenue sits at $184.7 million. So the top line growth is explosive, clearly driven by this new AI cloud revenue coming online.
The top line is undeniably strong, yeah. I'll give them that. But as we look deeper at the profit, that legacy business is still acting like an anchor around their neck.
The crypto side.
Right. Net income for FY 2025 was $86.94 million, which, sounds solid on the surface. But the latest reports show a noticeable decline. And the sources point directly to Bitcoin headwinds as the culprit.
Right, because they haven't entirely escaped their past. Unpack that for a second. Why is Bitcoin dragging them down right now when the AI side is booming?
It all comes down to the post-halving economics of cryptocurrency.
Ah, the halving.
Yeah. As the reward for mining Bitcoin gets slashed in half, the sheer energy cost required to mine a single coin just skyrockets. So for legacy miners who haven't, completely upgraded to the absolute most ultra-efficient setups, the margins just get squeezed to zero, or they even turn negative.
Ouch.
Exactly. And that crypto drag pulled IREN's adjusted EBITDA down year over year to $201.69 million.
Okay, and for anyone unfamiliar with adjusted EBITDA, we're basically talking about the company's raw operating profit before the accountants factor in, interest, taxes, depreciation, and amortization.
Right, strips out the noise.
Yeah, it's a look at the core engine of the business.
Yeah,
And what you're saying is that engine is losing horsepower.
it is.
Though, to be fair to IREN, their cash from operations is remaining quite robust at $245.89 million. So there is actual, tangible cash moving through the business today.
Well, sure, cash from operations is the lifeblood here. It shows that despite the declining margins in crypto, the day-to-day business overall is still generating liquidity.
All right.
But, and this is a massive, but liquidity doesn't mean much if your obligations are just mountainous.
Yeah.
If we shift over to the balance sheet, we see a company with a very heavy footprint. They boast $2.94 billion in total assets.
That's a huge number.
It is, but that's matched against only $1.82 billion in total equity.
Right, and this is where it gets really intense, folks. The most staggering number on their balance sheet right now, and it's hard to even wrap your head around this, is a massive $3.6 billion GPU financing package.
Yep, $3.6 billion.
And they secured this from Goldman Sachs and JP Morgan. But before we get to that specific loan, I just have to frame the extreme volatility of the stock for you. If you look at the 52-week range, this stock has swung from a low of $5.13 all the way to a high of $76.86.
It's just wild.
Just think about the sheer turbulence of holding a stock that does that in a single year. $5 to $76.
I mean, it is a purely binary bet for a lot of traders right now. A swing from $5 to $76 reflects a market that is fundamentally confused about how to value the company.
Yeah, totally confused.
They're asking, are they a dying crypto miner or are they an AI infrastructure giant in the making?
Which brings me back to that $3.6 billion financing package. Because I really have to push back on how some people view this.
Okay, go ahead.
A lot of retail investors, they see the names Goldman Sachs and JP Morgan on a press release, and they immediately think, wow, institutional validation. The big boys believe in them.
Oh, yeah, always.
But I have to ask, is backing from major banks actually a sign of institutional strength? Or is this just a terrifying debt burden hanging over a company whose net income is, as we just said, actively declining?
See, you're touching on the exact risk that gets completely overlooked in the hype cycle. Institutions like Goldman and JP Morgan, they do not hand out $3.6 billion because they believe in your dream.
Right. They don't care about the dream.
They don't. They hand it out because they see physical, liquid assets that they can seize if you fail.
Wow.
This is asset-backed financing, the highly specialized AI chips, the secured power infrastructure, that all acts as collateral.
So the banks are protected either way. If IREN crushes it, the banks get their interest. If IREN goes bankrupt, the banks literally just take the GPUs.
Exactly. They just take the hardware. But for the company itself, debt is a ruthless master. When you take on that kind of leverage, your margin for error shrinks to absolute zero. If the AI cloud revenue doesn't scale as fast as the monthly interest payments on that $3.6 billion, that debt becomes an existential threat. It really doesn't matter whose name is on the loan.
Right. So with that kind of debt acting as a pressure cooker, how is the market actually pricing this stock day to day? Because that underlying financial tension, it has to bleed into the charts.
It definitely does.
Let's look at the technical analysis and the order flow battleground.
This is where we see market psychology playing out in real time, you know? If we look at the trend direction right now, the moving averages are currently signaling a strong buy.
Let's break those numbers down so they actually make sense to everyone listening. The current price is sitting at $48.72.
Right.
That is comfortably above both the 20-day simple moving average, which is at $47.67, and the 50-day simple moving average, which is way down at $45.09.
Right. And for context, a simple moving average is exactly what it sounds like. It's the average closing price of the stock over the last 20 or 50 days.
Simple enough.
Right. So when the current price sits above those averages, it tells us definitively that buyers have been willing to pay a premium over the historical baseline. It confirms an active short-term uptrend.
Okay, so the trend is your friend.
For now, yeah. But an uptrend doesn't mean the stock is flying through empty airspace. It has to navigate psychological floors and ceilings.
The support and resistance levels.
Exactly.
So right now, immediate support, the floor basically beneath the current price, is hovering between $44.50 and $44.94.
Yep.
And if the stock falls through that floor, there's a much deeper drop waiting, all the way down to the next level of support at $36.52.
That's a big drop.
Huge. On the upside, though, the stock faces immediate resistance ceilings at $48.73, then $49.66. And if it somehow breaks through those, there is a massive major hurdle waiting at $66.39.
We really have to understand why those ceilings exist, because resistance levels aren't just arbitrary lines on a chart that technical analysts draw.
Right, they represent real behavior.
They represent actual people. A level like $66.39, that is a price point where a lot of traders bought in during the previous hype cycles. So when the stock dropped from there, they were left holding really heavy losses. Now, as the price creeps back up towards that 66 mark, those trapped buyers are just waiting to sell the exact moment they can break even.
Just to get their money back and get out.
Exactly. And that creates a massive wall of downward supply.
So to break through those ceilings, you need serious, sustained momentum. Let's look at the momentum indicators. The Relative Strength Index, or RSI, is sitting around 60 to 65.
Right, and the RSI measures the speed and change of price movements on a scale of 0 to 100. At 60 to 65, it is firmly in that neutral to overbought territory.
Okay.
It shows short-term strength, meaning the buyers are still in control, but the engine is getting a little warm.
Okay, but here is where the technicals get really messy.
Yeah, they do.
Because while the RSI shows strength, the MACD, the moving average convergence divergence, is positive. Yeah. But it's showing a bearish divergence.
A classic warning sign.
Yeah, and I want to make sure we really understand what that means. Let me try an analogy here. It feels like driving a car that is moving incredibly fast, but the driver is just taking their foot off the gas.
That is actually a very apt way to describe it. In market terms, the MACD looks the relationship between two moving averages to gauge the underlying force of a trend.
Okay.
So the price of IREN is still inching up, like you said. The car is still rolling forward on inertia, but the bearish divergence tells us the underlying volume of buyers pushing it is drying up.
So the momentum is carrying you forward, but the underlying acceleration is completely stopped. Meaning, if they hit a pebble, the car stops. The current short-term strength might just be a mirage before a pullback.
It's an early warning system that the buyers are exhausted, but, we can't look at that in a vacuum either.
Right.
Because if we pivot over to the options market, where traders are making highly leveraged bets on the future, the order flow is actually showing moderately bullish sentiment. The order flow is currently at 0.70.
Let's unpack that ratio really quickly.
Sure. A put is essentially an insurance policy, right? Or a bet that the stock will drop. A call is a bet that the stock will rise.
Okay.
So a put-call ratio of 0.70 means that for every 10 calls being bought, there are only 7 puts being bought.
Got it.
The options market is physically putting its money on the upside.
So you have this incredibly complex technical picture. You've got strong price action and bullish options traders, but underlying momentum indicators whispering that the rally is running out of breath.
It's a mess.
If the charts are flashing these massive conflicting signals, somebody is going to be spectacularly wrong. We have to look at who is actually putting their money on the line. Let's look at the short sellers versus the analysts and the insiders.
Man, the landscape here is explosive. Let's start with the short sellers. Currently, a massive 17.7% of the float is shorted.
Wait, 17.7%.
Yep. That represents $1.92 billion actively betting against IREN Limited.
That is a staggering amount of money betting on failure, nearly $2 billion.
It's huge.
But we know that high short interest is a double-edged sword, right? Because it sets the stage for a potential short squeeze. Explain the mechanics of a squeeze for us, just so everyone is on the same page.
Well, when you short a stock, you are literally borrowing shares from someone else and selling them, hoping to buy them back later at a much lower price to return to the lender. And you pocket the difference.
Right. Sell high, buy low, but in reverse.
Exactly. But if the stock price goes up instead of down, your potential losses are mathematically infinite. The stock can keep rising forever.
Terrifying.
So you are eventually forced to buy the stock back at whatever the current market price is just to stop the bleeding.
So if any upcoming news is surprisingly positive, those short sellers panic. They have to buy the stock to cover their positions, which creates artificial buying pressure, driving the price up even faster, which forces more short sellers to cover.
It acts exactly like rocket fuel. When nearly 18% of the available shares are forced into a panic buying loop, it creates violent upward price action. And that brings us to the analysts, who seem to think positive news is exactly what's coming.
Yeah, because the consensus analyst rating right now is a moderate buy. And breaking that down is pretty optimistic. 55% say strong buy, 27% say buy, 9% say hold, and only 9% are saying sell.
That's a lot of bulls.
It is. Even more striking, the average price target from Wall Street is $72.07. From our current price of around $48, that suggests a massive 48% upside.
Wall Street is clearly buying into the long-term AI infrastructure narrative. They are looking at the global demand for compute power and modeling these massive future cash flows. And everyone is circling one specific date on the calendar, May 13, 2026.
The upcoming earnings report.
Correct. Analysts are expecting an earnings per share of negative $0.23 on revenue of $227.5 million. This earnings call will be the critical catalyst.
Because it's a show-me moment.
Exactly. The market doesn't just want to see the revenue hit that 227 million mark. They want a highly detailed update on the GPU deployments and the energization status of their data centers. Any positive surprise there could ignite that exact short squeeze we just discussed.
Hold on, though. I have to interrupt the bullish optimism here because there is a glaring negative signal in the sources that we cannot ignore.
I know exactly what you're going to say.
You mentioned Wall Street sees a 48% upside. But there has been absolutely no major recent insider buying.
None.
In fact, the last notable transaction was an insider sale all the way back in September 2025. I want you, the listener, to consider this major disconnect. If Wall Street price targets are so confidently predicting a 38% upside, why aren't the company's own insiders, the executives who know the business better than anyone, why aren't they buying the stock right now?
It is one of the most reliable red flags retail investors need to watch.
Absolutely.
You have to remember the difference in perspective here. Analysts build financial models based on optimized projections, right? They use Excel.
It's all theoretical.
Yeah. Insiders live the reality of the daily operations. When insiders aren't buying, it implies they see operational hurdles, supply chain delays, cost overruns, maybe grid connection issues that just aren't fully reflected in Wall Street's optimistic spreadsheets.
It doesn't guarantee failure, but it absolutely signals caution.
Definitely.
So this massive tension between Wall Street's glowing optimism and the insider's hesitation, it forces us into the ultimate debate. We need to weigh the absolute best-case recovery scenario against the worst-case continuation lower. Let's do it. Is IREN an undervalued AI darling or a volatile value trap?
Okay, let's start with the bull case, the undervalued AI darling narrative. Some valuation platforms have run these massive forward-looking models and estimate a fair value for IREN at an incredible $95.75.
Almost double where we are today.
Right, and this bullish thesis is basically built on three massive pillars. First, a staggering $9.7 billion contract with Microsoft.
Which is huge.
In the infrastructure world, that kind of enterprise partnership is the holy grail. It provides guaranteed revenue visibility for years. Microsoft doesn't want to spend the time building every single data center themselves. They need the compute power yesterday, so they lease it from companies like IREN.
Okay, so that's pillar one, guaranteed Microsoft money.
Pillar two is their ambitious plan to deploy 140,000 GPUs by the end of 2026.
Which is an insane amount of specialized computing power.
It is. It's massive. And it leads directly to their third and perhaps most critical pillar, power itself. IREN has secured 4.5 gigawatts of power.
And that's practically a city's worth of electricity.
Pretty much. In the world of AI, chips are absolutely useless without dedicated grid access. You cannot run 140,000 GPUs without massive, reliable, and preferably cheap electricity.
Right.
So the bulls argue this 4.5 gigawatts of secured power acts as an impenetrable moat against competitors trying to scale in the space.
Okay, I hear the bull case, the moat, the GPUs, the Microsoft contract. It sounds great. But let's look at the bear case because the value trap narrative is incredibly compelling. You mentioned a fair value of $95.75 from some models, but Peter Lynch models, which focus entirely on a different set of metrics, suggest a bleak fair value of just $4.37.
Yeah, that's quite a gap.
Walk us through why there is a $90 difference in those models. How can they be looking at the same company?
Well, it comes down to philosophy. The $95 platform models are heavily weighting future growth and those crazy AI multiples, right?
Sure.
Peter Lynch models, named after the legendary value investor, focus heavily on current earnings and the PEG ratio price to earnings relative to growth. Since IREN's current net income is being weighed down by crypto headwinds and they have massive debt service costs eating into their margins, Lynch's strict fundamentals-based model sees a company burning cash today, not a giant of tomorrow.
You can see it's a fundamental nightmare.
Exactly. And the bears point directly to those extreme downside risks. We discussed the $3.6 billion loan earlier. When you factor that in, IREN has a staggering 153% debt-to-equity ratio.
Wow.
Add in the rapid cash burn required to physically buy all those GPUs and build those data centers before the Microsoft money fully flows in, and the financial tightrope becomes very clear.
Not to mention the beta. Let's talk about the beta,
Oh, right.
because the sources show a beta of 4.31. For anyone listening, a beta of 1.0 means the stock moves exactly with the broader S&P 500. A beta of 4.31 means IRN is over 4 times as volatile as the entire market.
Which is exactly why retail traders often get trapped. They see a massive run-up in the news, they buy into the hype at the absolute top, and because the stock is so hypersensitive, over 4 times as volatile as the market, a slight delay in a single GPU shipment from NVIDIA or a broader market dip can cause the stock price to absolutely crater.
And it leaves them holding the bag.
Exactly.
I want to push back on the bulls' biggest argument.
Yeah.
This idea of the power moat.
The 4.5 gigawatt?
Right. They boast about having 4.5 gigawatts of secured power. But if their massive debt-to-equity ratio of 153% crushes them beneath the interest payments before those 140,000 GPUs are fully deployed and generating cash, all of that secured power might not matter at all. Right now, their supposed moat feels like it's filled with debt instead of water.
Let's adjust that analogy. If you can't pay the massive mortgage on the castle, the bank simply takes the moat.
Exactly.
If they burn through their operational cash flow trying to service the debt of the JP Morgan and Goldman loans, that 4.5 gigawatts of power just becomes a distressed asset they are forced to sell off to stay alive, rather than a competitive advantage they can leverage. The entire bull thesis is a race against time between infrastructure deployment and debt maturity.
So what does this all mean for the timeline?
Yeah.
Reconcile these extreme bullish and bearish outlooks so the listener know exactly what to watch for next.
Well, in the short term, meaning the next few days and weeks, you should expect highly volatile but generally bullish consolidation. The chart suggests the price will likely bounce violently between that $44 support floor and the $50 resistance ceiling, as the entire market just holds its breath waiting for the May 13 earnings report.
Right. May 13 is the immediate flashpoint where we get to look under the hood again. But looking into the medium to long term.
Long term, everything hinges on execution, specifically the successful energization of their Sweetwater facility.
The new data center.
Right.
Yeah.
If they can get that facility online, successfully deploy the chips without massive technical delays, and hit their stated target of $3.4 billion in annual recurring revenue, or ARR, that is what could trigger a massive re-rating of the stock toward those Wall Street price targets.
It's a completely binary outcome. Hit the $3.4 billion ARR target, the debt suddenly looks manageable, the pivot looks like an absolute stroke of genius, and the stock re-rates higher. Miss the target or face deployment delays, and that 153% debt-to-equity ratio suddenly looks terrifying.
Exactly. And the tension between those two outcomes is what makes this transition so fascinating to watch. We are basically watching the birth of a new industry being built on the bones of an old one.
Yeah, we really are. As always, I want to remind you one last time that this deep dive is strictly for educational purposes and is not financial advice. We are simply unpacking the incredible tension locked inside these numbers. So I'll leave you with one final provocative thought to mull over as you watch this story unfold.
Lay it on them.
Let's look 5 years down the road. Right now, AI compute power is incredibly scarce, which is why Microsoft is paying billions for it. But if AI compute power scales so rapidly that it becomes abundant, a basic, cheap commodity like standard cloud storage is today, does IREN's massive $3.6 billion investment in GPUs today make them the ultimate foundational kings of the new tech era? Or, as the technology inevitably gets cheaper and faster, will they be stuck holding the most expensive depreciating assets in history? Let us know what you think in the comments.